Imagine walking into a room full of, Wall Street risk managers, and you slide a proposal across the desk.
Right. They're already skeptical.
Oh, completely. You tell them you plan to lend a massive amount of money to 20-somethings in emerging markets.
They would literally laugh you out of the room.
Exactly. I mean, they'd predict a tidal wave of defaults. Because in emerging markets, non-performing loans, those are the loans where borrowers just stop paying. They are the silent killers of retail banks.
Yeah, you'd expect those default rates to just spike and bleed the balance sheet dry.
But what if you told those risk managers your default rate was sitting below 2%?
Yeah.
Let's look at the actual banking segment data here. We are seeing a monumental swing from a negative $86.5 million net income last year to a positive $84 million this year.
Which is a staggering turnaround.
It really is. And the kicker. They pulled off this massive profitability swing while maintaining an incredibly low non-performing loan ratio of just 1.91%.
Yeah, that is a rare feat in emerging market retail credit. And that specific metric, that incredibly precise execution of credit scaling, it forces us to completely reevaluate our assumptions about digital finance in Central Asia.
I mean, when you see a turnaround of that magnitude without a corresponding explosion in bad debt, it tells you something profound.
It tells you the underlying underwriting engine is actually working. So this deep dive is going to look way past just a standard earnings review.
We're looking at a blueprint of a rapidly maturing digital economy.
Exactly. The core thesis we're exploring today is that Freedom Holding Corp proves a tightly integrated digital ecosystem can capture immense demographic scale in Central Asia.
And not just capture it, but move rapidly from like a shiny consumer novelty to an institutional-grade financial infrastructure.
Right.
So why should you, the listener, care about this, especially if you're an emerging market allocator,
Yeah.
someone whose job is to decide which global regions get institutional investment capital?
Well, why this specific corner of the globe?
Exactly. We're going to answer that today using hard data. But to understand the turnaround and the growth, we really have to map the architecture of the machine itself first.
Yeah, we have to look at what exactly this entity is.
So what are we looking at?
Well, at its core, it's a sprawling digital ecosystem spanning 22 countries.
Wow, 22.
Yeah. The geography includes the U.S., European nations, and of course, Central Asian countries. The physical footprint operates through 230 offices.
That's a massive physical presence for a digital company.
It is. And the human capital backing this up is huge, coming in at over 11,800 employees.
Okay, so structurally, what does it actually house?
Structurally, you have traditional financial services, brokerage, banking, insurance, but then it bleeds into entirely non-financial sectors.
Like what?
Telecommunications, e-commerce, and even online ticket sales.
Wait, I need to stop you there. I mean, I get the concept of a digital walled garden.
Right, the SuperApp model.
Yeah, exactly, where the user never actually needs to leave. You trade stocks, get a mortgage, buy your groceries, stream a movie on a telecom network, all owned by the same holding company.
Yeah, it's comprehensive.
But I have to push back a little on the operational reality of this. Are they really laying physical fiber optic cables while concurrently managing institutional wealth?
I know, it sounds crazy.
It's like finding out your accountant is also, pouring the concrete for your driveway. I mean, it's either sheer genius or a recipe for disaster. Is this just a structural house of cards where they're trying to be everything to everyone?
Well, that's the exact friction point any serious allocator needs to interrogate. To see if the structure holds up, we can't just look at the holding company as one giant entity.
Right, we have to break it down.
We have to trace the cause and effect relationship across their business segments. We need to look at how one segment actually feeds the next.
Starting with the base layer, I assume.
Exactly, the ecosystem scale and the trajectory of their SuperApp. The core achievement here is that they're capturing the next generation of wealth accumulators long before traditional legacy banks even know those individuals exist.
And the evidence for that scale is honestly striking. They have over 8.1 million clients in this digital ecosystem.
It's a massive user base.
It is.
Yeah.
But let's break down who these people actually are, because the demographics tell a very specific story. The user base is 55% female.
Right.
Furthermore, it's overwhelmingly young. Like, we see that 27% of users are aged 25 to 35.
And then another 26% are aged 18 to 24.
So over half the base is under 35. And they're keeping these young users engaged with a loyalty program offering up to 23% cash back for in-ecosystem purchases.
Which is huge. Let's expand on the mechanics of what that means for a lifetime value.
Okay, lay it out.
Traditional legacy banks spend fortunes on marketing to acquire, say, a 35-year-old customer who is finally ready for a mortgage.
Oh yeah, it's a highly competitive, incredibly expensive process.
Exactly. By capturing that user at age 20 with lifestyle services like event tickets or e-commerce, incentivized by that heavy 23% cash back, the customer acquisition cost for future financial products effectively drops to zero.
Because you already own the relationship.
You already have them in the ecosystem.
So that 23% cash back isn't just like a marketing gimmick or a loss leader.
No, not at all.
It's the actual gravitational pull of the ecosystem,
Yeah.
keeping the capital circulating internally.
Precisely.
But here's my question. How do you fund a SuperApp with over 8 million people? Offering 23% cash back requires heavy, heavy capital. You don't fund that with spare change.
No, you fund it with your financial reactor.
Your reactor.
Yeah, you need a core segment that powers the rest of the grid. And in this case, that reactor is the brokerage segment.
Oh,
It's the highly profitable engine driving the entire holding company. Consider the scale here. Revenue hit $831.5 million.
wow.
And the net income generated by this segment was a robust $371.9 million.
So they achieved this scale with 858,000 clients.
Right.
And what really stands out to me is that it's not just concentrated in one domestic market.
No, it's very diversified.
Yeah, the client base is 56% in Kazakhstan, but they also have an impressive 42% in Europe.
Which shows real international traction. And this operational strength is validated externally, too. It's supported by an S&P rating of B+ positive.
That external validation definitely matters. But internally, this robust profitability provides this overarching equity base of $1.5 billion.
Yes, and think about the strategic advantage of that $1.5 billion equity base.
It's essentially a massive safety net.
It allows the holding company to self-fund its broader ambitions. They don't have to constantly return to the capital markets, cap in hand, diluting their shareholders just to build the next piece of the SuperApp.
But holding $1.5 billion in equity isn't the end goal, right? It's ammunition.
Exactly.
What do you do with that war chest? You use it to insulate your riskier ventures. Which brings us directly back to how they managed to stabilize that banking arm we opened the deep dive with.
Right, the $84 million swing.
Yep. That brokerage capital effectively bought the company the time and really the breathing room required to fix, optimize, and scale its credit operations.
They transitioned from what looked like an aggressive, potentially costly expansion phase directly into profitable, high-quality credit scaling.
The stabilization is pretty undeniable at this point.
They now manage a $2.1 billion loan portfolio.
And this is balanced against a $3.1 billion deposit portfolio.
Which circles back to the metrics that just completely defy traditional banking logic.
Yeah, remind us, we have that swing to a positive $84 million net income.
All while maintaining a 1.91% non-performing loan ratio.
This is where I really need you to break down the actual mechanism for us.
Okay, sure.
How does a digital bank manage to scale a multi-billion-dollar credit portfolio to a user base of mostly young 20-somethings while keeping defaults under 2%?
It comes entirely down to the ecosystem data advantage. Let's look at the mechanics. A traditional bank only sees a very narrow slice of your financial life.
Right, they see your paycheck clearing, maybe your credit card bills.
Exactly. But a SuperApp ecosystem sees your grocery habits, your telecom bill payments, your e-commerce purchases, and the stability of the assets you hold in your brokerage account.
So they have the full picture.
Let's say the algorithm sees a 24-year-old. They're consistently paying their telecom bill on time every month. They're utilizing their cash back for everyday essentials, not, speculative purchases.
Okay, making responsible choices.
Right. And they hold steady, diversified assets in their brokerage account. The algorithm basically generates a 360-degree view of their financial health.
So while a traditional legacy bank just sees a young kid with a thin credit file and stamps denied on the application,
this ecosystem sees a low-risk prime borrower.
that makes total sense. That is the core mechanism at play.
This vast alternative data matrix allows for algorithmic underwriting that is just far more predictive of default risk than a standard 3-digit credit score.
It demonstrates that the management team really understands how to pull the right operational levers to stabilize a massive digital bank.
Yes.
Okay, so the bank optimized for profit over blind, unchecked growth. But what about the other financial pillars? Are they applying that same disciplined logic across the board?
They are. We're seeing the exact same mature discipline in the insurance segment, for instance.
Really?
Yeah, the critical achievement here is actively prioritizing margin over top-line vanity metrics.
Walk us through the mechanics of that. I mean, why would an insurer intentionally write bad policies in the first place?
Well, it usually comes down to misaligned incentives. In emerging markets, you often have commission-driven agents who just want to close the sale.
So they just underprice the risk to get the signature.
Exactly. And the company boasts about massive revenue growth on their quarterly calls to appease investors, but 2 years later, the claims roll in and the balance sheet bleeds.
Oh, wow.
Walking away from that kind of volume takes immense discipline.
And the numbers highlight this paradox beautifully. Insurance segment revenue actually dropped 21.8%, down to $497.7 million.
Right.
Now, on the surface, a 21% drop in revenue sounds like a glaring red flag.
You don't usually celebrate shrinking.
No, you really don't. But here, it looks like a highly calculated trimming of unprofitable fat. Because while revenue fell, the net income more than doubled from $10.3 million to $22.6 million.
And the broader market recognizes this stability, evidenced by an S&P rating of BB stable for this subsidiary.
But wait, doubling net income while revenue drops 21% sounds great on a spreadsheet, but practically, how much of your sales force are you alienating to achieve that?
A lot.
I mean, that requires a massive cultural shift inside the company to just walk away from sales.
It undoubtedly does require a cultural shift, but that is exactly what institutional investors want to see.
Right.
Walking away from unprofitable market share, retraining your underwriters, and doubling your net income is the hallmark of a management team that understands capital efficiency over ego.
They aren't interested in subsidizing bad policies, just to brag about revenue size.
Exactly.
So we have the three financial pillars, brokerage, banking, and insurance operating highly profitably. The holding company is generating massive cash flow.
Yes.
And this is where the story takes a striking turn. They're taking that digital profit and using it to secure their own physical future.
Right. They're moving from digital software into hard physical infrastructure via Freedom Telecom.
It's incredibly ambitious. I mean, they're building proprietary optical lines and their own 5G network.
The evidence shows a planned $325 million investment volume for 2023 to 2025.
And they're already gaining real traction. They're boasting over 5,000 corporate clients.
Additionally, they've secured about 31,800 retail clients.
To explain why a financial company is building a telecom network, think of it like a massive digital streaming service deciding to buy its own internet service provider.
That's a good comparison.
They do it just to guarantee the delivery of their content to the end user. It sounds extreme, but it guarantees quality control. If the local internet goes down, your streaming service is useless.
And it insulates the SuperApp from third-party network risks. If you own the physical pipes, you control the data flow.
Right, you don't have to pay tolls to a third-party telecom operator.
By integrating the data usage directly into the ecosystem, you inherently lower long-term customer acquisition costs across the entire platform.
But building physical infrastructure while running a massive digital bank is not without serious friction.
No, definitely not.
Let's look at the execution risks here. Is the operational risk of laying physical fiber optics too far outside their core competency of writing financial code?
It's a fair question.
Are they stretching themselves too thin by playing in the dirt while trying to run a bank?
Look, this is a necessary reality check. This isn't a bear case, but an allocator has to acknowledge the operational heavy lifting involved here.
Scaling a capital-intensive telecom business with a $325 million investment volume requires a totally different skill set than pushing software updates.
Doing this while concurrently managing a growing $2.1 billion loan portfolio requires flawless management bandwidth.
Capital allocation mistakes in physical infrastructure are permanent. You can't just delete a trench you dug in the wrong place.
Exactly.
So given those execution risks, what are the exact metrics you should put on your dashboard to monitor this trajectory?
You mean the opportunity signals we should watch over the next few quarters?
Yes, exactly.
I would focus on three specific forward-looking signals. First, monitor the brokerage geographical shift.
Okay.
You want to track if the European client base, which currently sits at 42%, overtakes the Kazakhstan base, which is currently at 56%.
And why does that matter?
If Europe becomes the majority, it signals a true global footprint that extends far beyond their home region.
That makes sense. Second, you have to keep an eye on the telecom retail scaling. The opportunity here is tracking if they can rapidly convert those massive ecosystem numbers.
Right, turning those 8.1 million digital ecosystem clients into telecom users.
Because right now, that retail telecom base is only at about 31,800.
The gap between those two numbers is the literal runway for growth.
Yeah, if they close that gap, the revenues will just explode.
And the third signal is the SuperApp user monetization timeline.
Okay.
Specifically, track how effectively the 53% of users under age 75 graduate into higher margin banking and insurance products over the next 12 to 24 months.
So if those young users start aging into mortgages, car loans, and life insurance within the ecosystem,
Then the lifetime value calculations go completely parabolic.
we've covered the demographic scale, the profitability engines, and the real infrastructure risks. Give us the one number, the single figure that best captures the scale of the opportunity this company represents.
$13.2 billion.
Let's contextualize that for everyone.
That is $13.2 billion in total assets as of March 31st, 2026.
Wow.
This figure proves that this company is no longer just a scrappy fintech disruptor testing out a neat super app concept.
It's a systemically important institutional powerhouse in Central Asia.
Exactly. They've built the asset base to rival legacy institutions, but they've retained the technological agility of a startup.
So what does this story mean for how global investors should think about Central Asia's digital finance decade ahead?
It changes the entire paradigm.
It does. The FY 2026 report reveals a very clear reality. Central Asia isn't just passively participating in digital finance, waiting for Western trends to arrive.
The region is leapfrogging legacy systems entirely.
They're blending hard physical infrastructure with a closed-loop digital economy in a way that Western markets have fundamentally struggled to replicate.
And this raises a critical, provocative question for you to consider as you observe this evolution.
What's that?
If a digital finance ecosystem is now building its own 5G telecom networks just to guarantee the delivery of its services, what does the definition of a bank actually look like 10 years from now?
That is the thought we will leave you with today. We encourage you to look at the SEC filings yourself to see the blueprint of the future.
It's all right there in the numbers.
Because when you see how they manage a multi-billion-dollar credit portfolio alongside a massive digital ecosystem, the picture becomes clear.
Very clear.
That shockingly low default rate we talked about at the start, it isn't an anomaly, it's a result of a meticulously built machine. Thanks for joining us on this deep dive.